2018 was another year of delivery by Segro, where we achieved excellent financial results across the board. We reported a 17.6% increase in adjusted earnings per share to 23.4 pence. We reported over £900 million of portfolio valuation surplus, and that helped to contribute to a net asset value increase of 16.9% to 650 pence per share. These excellent results were supported by strong occupier demand across all our markets and by our own disciplined approach to capital allocation and our operational excellence. Our focus on customers has enabled us to deliver some excellent operational data, including a phenomenal £67 million of new annual rent commitments. We've delivered 40 development projects, contributing £40 million of new rental income when fully leased. 83% of that income is already secured. And we've sustained high customer retention rates, we've maintained our very low vacancy rates, and these have contributed to a 3.1% increase in like-for-like rental income. In terms of development, we've delivered some amazing spaces in 2018. For example, we've built a Premier Inn and a Costa Coffee in Slough on the trading estate, as well as another data centre. We've produced more space for Amazon and Ukes in Italy. We've delivered for our biggest customer in Poland, Corning. We've created some speculative space in Germany, which is leasing up very well. And in the East Midlands at our flagship Gateway scheme, we're close to completing our four biggest developments, our first four big pre-lets. And probably the most exciting development of the year was the completion of our two-storey scheme in Paris, which was fully leased up to Leroy Merlin and IKEA long before we even completed the building. So across the board, a really exciting year of development. We've continued to take a disciplined approach to capital allocation, investing a net £327 million during the year. We committed over £700 million to development and land purchases, but we've also made some exciting bolt-on acquisitions of built assets, particularly of urban logistics portfolios in our continental European business. And we've also been keen to take money off the table. For example, we've sold assets out of Italy, out of Belgium, and indeed we've sold some more mature assets in East London, as well as crystallising some value creation by selling an industrial site for residential development in the west of London.
We're reporting some very strong results this morning, which reflect the success of our strategy and all that hard work that goes into implementing it. Earnings per share is up strongly, 17.6% to 23.4 pence. The net assets of the company are up £1 a share to £6.50p, and that's really been driven by the valuation of our property portfolio that's now worth £9.4 billion. That's up over £1 billion through the course of 2018. Given these strong results and our confidence in the outlook, the board has approved an increase in our dividend to 18.8 pence, which is up 13% year on year. The balance sheet remains in great shape. Loan to value is just 29%. We've got over £1 billion of cash and available facilities, and the cost of debt remains low at 1.9%.
Despite a number of macro uncertainties, not least Brexit, we entered 2019 with confidence of our ability to further outperform. And that confidence is born out of three things. Firstly, we have an excellent portfolio of prime assets in great locations and a terrific land bank. Secondly, we have an incredibly diverse portfolio with very little exposure to some of the more troubled sectors of the economy. And thirdly, we're exposed to a number of very powerful structural drivers in our sector, most notably urbanisation and the digital economy, particularly e-commerce. And that puts us in good stead. So our cash flows are very resilient, and we have great potential for further growth in rents and in development gains. We started 2019 with a very large programme of on-site development projects, 38 of them to be precise. That's equivalent to £46 million of new rental income, of which 73% has already been pre-leased. And on top of that, we have a bumper crop of further near-term projects that are close to starting and which will be adding to the pipeline in the weeks and months ahead.